Haney Farms has been in the seed business since 1937 with a full line of cereals, corn, and canola seed. Find us at haneyfarms.com. We're joined right now on RealAgriculture.com by Ron Frost. He is with Ron Frost Forecasting Consulting. Welcome today, Ron.
Hi, Sean. Nice to be with you.
Ron, you recently sent me a report talking about the realities of the new commodity price plateaus. Why do you think the reality of this new price plateau is here?
Well, it goes back to, I think that in history, if you take a look back, even 100, 150 or more years, you'll notice that grain prices have a tendency to go up in about 30, 35-year price plateaus and step up over that time period, whereas your cost of machinery, inputs, and other costs tend to have a kind of an inflationary smaller increment every year. So I think certainly it's due. We had a major step up in the post-World War II, another one in early 70s. So we're right on schedule to have another step up here, and certainly the price action is indicating that this will likely be sustained.
So Ron, are you predicting that this is kind of across all ag commodities, or just specifically things like corn and soybeans?
No, it's probably across all general grains and oilseeds on that. I haven't done as much analysis relative to the livestock industry that would tie into this, but obviously if grain prices are higher, costs going into the livestock industry would be also up. So I think this is a general step up in all agricultural commodities. Certainly if you get into a very broad context and take a look at something like the CRB index, clearly it is just simply made new highs this week again, even above the 2008 high. So it's a broad-based elevation of prices.
How much do you think that has to do with speculators being so interested in the market, Ron? RCAF came out, I think it was yesterday actually, and said, we need to limit the amount of speculation that's in the market because it's not allowing people to properly hedge their commodities. Do you think that the added interest of hedge funds in ag commodities has really caused this price plateau?
It certainly hasn't caused it. It will increase the volatility, and it will cause overshoots on price highs and probably overshoots on price lows because you have a couple of specific different types of fund money in there. You have the index fund money that basically only takes on long positions. And then, of course, you have the trend following funds that will go on either side of the market. After you have major tops put in and the market beginning to turn down, clearly there will be a lot less interest in new fund money going into the indexes as every month they're lower, every quarter they're lower. But when you come out of a major bottom, you're going to have both of those fund components on the same side of the market, as well as clearly the fundamentals that would be driving it up. So they're going to create more volatility, but they're certainly not the cause for the elevation in the price.
So if I understand you right, what you're saying is that the volatility is increased, but really when we look at, say, the year of 2010, the average price is no different than it would have been if they would have been in or out. There's a wider range around that price.
That's right. There's a bit of a distortion between sometimes the futures markets and the cash. Obviously, the regulators in the U.S. are working at trying to bring convergence back into that. Clearly, that would resolve a lot of issues for the futures being a good instrument for hedging. And I think we will slowly work that process through.
Okay. So I guess if you had to, when you look at the commodity spectrum of ag commodities, what are a couple of the ones that you think are going to be the real highlights for 2011?
For 2011, I clearly have to lean towards corn, coarse grains. I think that when you take a look at a global perspective and a U.S. perspective, which, corn is a very large component of global coarse grains. It has the biggest challenge at putting enough acres in the ground and achieving a good average yield to build stocks. We've been looking at the corn market for the last 12 or more months that simply record production, record yields last year in the U.S. could not rebuild a carryover. And this is something that's changed dramatically since the 1980s and 1990s when we saw the production machine get up and fired up and going full steam. We would build massive carryovers very, very quickly, and that's no longer the case with the 1/3 of the U.S. corn crop going to ethanol, Europe using more than the entire Canadian canola crop for biodiesel. This is changing the dynamic of our prices because we can't build carryovers as fast.
Is that one of the reasons for this new reality of price plateaus that you've been talking about, is the fact that we don't all of a sudden have these huge surpluses of these crops like corn? You know, the biofuel program has really sucked up some of that excess supply.
Well, it certainly helps, prices in the short term. The reality is that we will adjust to a certain amount of that production being siphoned off. Genetics have come a long ways, as you know, in not only canola, corn, but pretty broad spectrum of production. We've been relying a lot on genetic improvements in yields to service the increased demand globally, and that will eventually slowly transition to where we will catch up with it. And if you take a look at the prices that we had in the late 1970s, those average prices there were probably a slight bit higher than what we had literally through the decade of the 80s and the 90s. So we're right now in the mode of the first few years after a major step up, and we should be looking at some of the best profits here over the next couple, 3 years that we're going to likely see for the next decade or more.
So Ron, what do you think is going to happen? How do you suggest that farmers deal with this new reality of a price plateau?
Well, one of the things that we're seeing now that we haven't had in decades past is that we do have futures markets trading out longer time frames. Currently, you can take a look at November 2012 canolas, $505 a ton. You've got corn and soybeans, wheat markets that'll trade fully out 2 crop years as well. And as we go through this price peak that we're in the process of finding where the top of it is here in the winter of this winter, we need to take a look at doing multiple crop years, capitalizing on prices that are well above the averages that we will likely be able to sustain over a 5-year period or more, so that we can stretch out the peaks that are typically V-tops as compared to the long, slow grinding bottoms that we have to live with.
Are there any ag commodities that don't fit into this plateau scenario you're talking about?
It's hard to pick those out because everything competes for acres on the grain side, on the livestock side. Of course, we have a large population in the world that is living still on below the poverty line, and as they elevate their incomes and their lifestyle, which really means elevate their eating standard, it is hard to find a commodity that probably isn't going to have to elevate itself with it. It goes pretty broad spectrum from energy to precious metals to grains and oilseeds to everything you can think of.
Okay, Ron, thanks a lot for joining us today at the end, I guess, a couple days before Christmas here. Really appreciate it, and we'll definitely be talking to you in 2011.
Thank you very much, Sean.